Welcome to this explainer. Okay, think about a company that literally birthed India's entire software services industry. Pretty massive, right? Today, we are unpacking the fascinating journey of Tata Consultancy Services, or TCS, and tracing exactly how they're transforming from a legacy IT behemoth into an absolute powerhouse in the artificial intelligence revolution. It's a story of incredible scale, hidden competitive advantages, and, as you'll see, massive financial firepower.
But before we even get into the history, I want to hook your attention with a very specific number, 51.81%. Now, in the world of corporate finance, that is a absolutely staggering return on equity. It establishes right out of the gate that TCS isn't just some large company holding steady, it is a colossal financial engine operating with breathtaking efficiency. So how did they build an engine that runs this hot? And maybe more importantly, where are they driving it next?
Okay, let's dive into this. Section 1, the Nifty 50 heavyweight, dominating the Indian market.
When we look at the Nifty 50, which benchmarks the performance of India's biggest corporate leaders, TCS is a structural pillar. TCS alone commands a massive 2.35% weightage in the entire index. To put that into perspective, the total information technology sector makes up 7.41% of the Nifty 50. So TCS is a huge chunk of that pie. Now, the market affords TCS this premium positioning along with premium price-to-earnings ratios for a very specific reason. As financial analysis platforms like Vesti point out, TCS generates enormous free cash flow relative to its earnings. And it's this cash flow that gives them the ultimate financial flexibility to navigate shifting technological tides.
Section 2. Tracing the legacy from 1968 to global IT leader.
So, let's trace how they built this giant. Because, TCS didn't just appear overnight. They were founded way back in 1968 as India's very first software services company. They practically invented the playbook. Fast forward to 2003, and they hit a massive milestone, crossing $1 billion in revenues. They were actually the first Indian software company to pull that off. The very next year, in 2004, they went public with a huge $1.2 billion IPO, and the growth trajectory just kept going. By 2018, TCS became the first listed Indian IT company to breach $100 billion in market capitalization. Today, this flagship company of the Tata Group isn't just an Indian leader. We're talking about a global IT expert leader operating across 46 different countries.
Section 3. The castle and the moat. The power of switching costs. That kind of sustained global growth isn't just about selling a good product once, right? It's really about making sure your clients never ever want to leave. In business strategy, there's this concept known as a competitive moat, a sustainable advantage that protects a company from its competition. For TCS, their absolute strongest moat is built on what's called switching costs. To wrap your head around this B2B concept, think of enterprise IT like the foundation and plumbing of a massive skyscraper. Once a corporation integrates its core banking or enterprise resource planning systems with a vendor like TCS, you can't just easily swap it out. It becomes enormously expensive and highly risky to change vendors without completely jeopardizing the entire operational building.
Let's break down exactly how this plays out in the real world. Step 1, TCS comes in and integrates a client's most critical foundational systems. Step 2, they embed their software and their support deep into the daily corporate workflow of that client. Once that happens, we reach step 3, which is where TCS retains immense pricing power over time. Literally ripping out a fully integrated TCS system is a logistical nightmare for a large corporation. And because those exit risks are just so high, client retention remains incredibly strong. That ensures highly predictable, long-term revenue streams for TCS.
Now, what's really interesting about this next part is Section 4, Stellar Financials, the returns engine. Let's see how that incredibly sticky switching cost moat translates directly into financial results. And we'll frame these numbers by anchoring them against standard good metrics in the investment world, using benchmarks from VestAI. For a healthy company, a consistent return on equity, or ROE, above 15 to 20% is considered a strong mark of quality. TCS, while they're operating at an ROE of 51.81%. It's wild. Then consider return on capital employed, or ROCE, which basically measures efficiency in capital utilization. A healthy baseline is anything above the cost of capital, ideally 15% or higher. TCS is sitting at a mind-bending 63.03%. These metrics are truly, absolutely extraordinary. They ensure we grasp the sheer magnitude of TCS's profitability and management efficiency. They are, quite simply,
a cash-generating machine. Section 5. The Gen AI Outlook, Investing in the Future.
But past performance and current dominance are really only half the story here. TCS isn't just sitting back on their cash flow, they're aggressively deploying it into the future. A perfect detail that showcases this is their massive $50 million investment to inaugurate the Tata Innovation Center at Cornell Tech. Now, this isn't just some glossy marketing exercise. It is a tangible, massive financial commitment to advanced joint academic and industry technological research and development. They are actively wiring themselves directly into the bleeding edge of tech innovation.
And this brilliantly illustrates the real-world financial impact of those forward-looking investments. According to market outlook reports by HSBC Asset Management, looking ahead to the fiscal year 2027, the IT sector is expected to see earnings growth likely near double digits. And what's the direct catalyst driving that? Increased generative AI adoption-related workflows, because TCS already owns the underlying digital infrastructure for so many massive global corporations. They are perfectly, strategically positioned to be the exact ones who integrate Gen AI into those workflows.
So what does this all mean? Well, it brings us to a really fascinating conclusion for this explainer. We so often think of AI as the space entirely dominated by nimble, disruptive startups. But when you look at the sheer scale, the incredibly high switching costs, and the boundless free cash flow of a company like TCS, it forces us to ask a much larger question. Do legacy giants with deep client moats and endless cash actually hold the ultimate advantage in the AI arms race? It's a provocative thought to chew on for sure, and it completely reshapes how we might view the future of digital innovation. Thank you so much for joining me and keep questioning the mechanics behind the market.